Welcome for this at-home edition of the Stock Play of the Day Overtime. This week's stock was Barrick Gold, symbol GOLD. We'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. This week's stock is Barrick Gold. We looked at a long call spread in the stock play of the day. And for the record, I do not own any shares of Barrick Gold. So let's jump right into it. Barrick Gold right now is currently trading at 27.66. It's up over the week. We actually see a chart, a 5-day chart here on Barrick Gold. When we talked about the stock, it was back here on Monday, right around noon Eastern time, so we were right in this range. We had a fairly decent run up right after the call going into Tuesday's market, and then a bigger run up all the way up to the 28 level. We were looking at getting the stock all the way up to 31 though, but it was approaching it fairly rapidly after we talked about that underlying stock. Then we had a big dip down in the underlying stock. And then guess what? We're almost right back to where we started when we first started talking about Barrick Gold. So as always, it's always meant to be a paper trade. And this is a great paper trade in that if you're following the prices, you can really see what happens to our long call spread as that underlying stock makes a little bit of a run up and a little bit of a run down. So the long call spread inside the options playbook here's the Ally Invest options playbook. What we're doing is, and specifically in this trade, we're buying a little bit of an in the money call option. And here it's represented by strike A. And then we sold a little bit out of the money call options, which is represented at strike B. It's going to be the same expiration date. The expiration date that we chose was the June 19th expiration. There was 46 days remaining to that expiration date when we first look at this trade. Now, obviously, it's a little bit later on. We're doing this call now on Friday, and we talked about that trade on Monday. So let's look at the Ally Invest option chains. And this is actually the profit and loss graph from the chains. So it looks fairly similar to the options playbook. The underlying stock is here right now, so it's representative of today. We had the run up, and this is at expiration is the dotted line right at that 31 point. That's where our maximum would be made on that underlying trade. The maximum that this trade could trade for would be the width of the spread, and the maximum gain would be that minus what we paid for that underlying trade. So let's scroll up here a little bit in our option chains and let's look at the actual trade. So at this point in time, with Barrick Gold now trading at 27.64, and on Monday it was 27.28. Okay, so 27.64 right now. As the market's moving, we're taping this live, and on Monday it was 27.28. So the trade that we looked at was buying the 24 strike call with the June expiration, June 19th expiration to be exact, and selling the 31 strike call. Now, in this instance, if we just focus on the midpoint, when we were looking at executing the trade, the paper trade, I should say, not meant to be a recommendation, as always, we're just trying to learn, it was $3.20. That means your maximum risk for the trade is $320 plus commissions. You got to add commissions on. Don't always want to remember to do that. And for every 1-by-1 spread that we do, one buy and one sell. Now we are trading at 344, so we are the price, the midpoint price of the spread is a little higher than it was when we first looked at the trade. So what might we want to do with this trade? Well, we had a big run up. Maybe you could have got out. Then we had a big run down. Maybe you panicked and you sold. But the biggest thing was to have a plan. And our biggest plan was mainly to stay the course because we already kind of reduced our risk by doing a spread trade. And we still have 42 days remaining till we get to that expiration date. So one of the first options, and I'll talk about a few of them here on the overtime edition of the stock play of the day, One of the options is to just stay the course, to just stick with it. There hasn't been a major swing in the underlying stock, either to get us out on the downside or on the upside, or up a little bit on the trade. You could obviously close it at any time, or you could just stay the course. Now, one other option is to look at the 31 strike call. You are short that call. That call wants the underlying stock to stay where it's at or go down, right? If the stock starts going up towards that short strike, this short call is going to hurt our position. And that's part of the reason why when you look at the profit and loss graph, the actual graph inside the Ally Invest option chains, you see the red line here, the colored line, I should say. It's red down here, but it's overall multicolored line. And you see that it's not close to the dotted line, which is the expiration graph. And as expiration approaches, if the underlying stock does go that way, it rewards you more closer to the expiration date than it does if the move happens right away. So I can do a little simple thing inside our profit and loss calculator is I can change the days of expiration. I can go down, let's just say 5 days. We're at day 42 right now. There's a lot of time left on this trade, but let's just go to 5 days and then it'll regraph itself. And you see how much different the multicolored line is as compared to day 42 when you look at as of day 5. Now, this is just a theoretical graph. It's not always 100% accurate because we're just using the current market conditions to try to look at the prices of our long call spread. But basically, that's the trade. So what's the other alternative? If you do think that, well, now maybe my view has changed a little bit, I want to get a little bit more bullish, another thing I could do is just remove this call option. When we looked at doing the call option on Monday, it was trading for around 80 cents, and we see right now it's 73 cents. So at the midpoint, if we could close out that position at that point, we'd have just a very small gain on our short call spread. Why is that? Well, the stock hasn't moved very much, but we've had some time decay. And that's a fact of life in option trading, that options do decay as expiration approaches. So that's the main reason why this underlying option contract, this short 31 strike call, is trading for a little bit less than when we put on the trade, especially considering that the actual stock has actually gone up towards that strike price. It's actually moved towards it. So in general, time decay is working for us here. All right, so that's it for this edition of the At-Home Stock Play of the Day Overtime. Don't forget to click subscribe and ring the bell. We go live every Monday with the Stock Play of the Day at noon Eastern Time. Thanks for coming, everyone.